1 week ago, this portfolio was worth $122,600. Today, it's worth $129,600. That's a gain of about $7,000, 5.72% in 1 week. It was a strong week, and the market finally gave me a signal I'd been waiting for. Normally, that would have been my green light to buy. But I didn't. I passed on the stocks I wanted most and instead made a trade I wasn't even planning on when the week started. So what changed? I'll show you why I refused to chase, what I did instead, and exactly what would make me put more money to work next. Welcome back to Precision Capital. This is the public record of every investment decision I make as I try to turn $100,000 into $1 million. Every trade is documented before the outcome is known. Let's start with what happened inside the portfolio. These were my top performers this week. The one I want to focus on is ServiceNow. My ServiceNow position is now worth about $10,200. It gained roughly $1,300 this week, about 15%. My total return on it is now around $1,200, or 13%. ServiceNow's kept recovering since its second quarter results, and the broader software group rallied hard on Friday too. That doesn't mean every concern about software has disappeared, but it made Now one of my strongest positions this week. Now, on the other side, these were my top losers. The one I want to focus on is Celsius. My Celsius position is now worth about $2,600. It lost roughly $270 this week, about 9%. My total return there is now down about $200, or 7%. Celsius reported earnings last week. The numbers weren't great, but nothing in the report changed my thesis on the company, so I'm continuing to hold the position. The real decision this week came from what happened in the broader market. The biggest change this week was the S&P 500. For most of the summer, the index had been stuck inside this range, with my upper resistance line sitting around 76,118. This week, SPX finally broke above that level and pushed into record-high territory. There was fundamental support behind the move, too. On July 31st, 2026, FactSet reported that 86% of the S&P 500 companies that had reported second quarter results were beating earnings per share estimates. Technology and semiconductors led the way higher, too. Semiconductors specifically mattered most to me. I'd been waiting for one very specific confirmation from SOXX, the semiconductor ETF. Last week, SOXX broke below my red support line around $498, then quickly moved back above it. I viewed that as a possible bear trap. But one bounce wasn't enough for me. I wanted to see SOXX hold above that level for a few days before I called the move confirmed. This week, it did. So by my own rule, the semiconductor rebound was now confirmed. And that's where the problem started. I'd been waiting for that confirmation before buying more Broadcom and starting a new position in Arista Networks. But by the time it came, the prices didn't work anymore. With Broadcom, I already own about 1/3 of the position I eventually want. My next add needs to be below $400 before I'm willing to commit more capital. Since I already own part of the position, I don't need to force another buy just because the sector looks stronger. I didn't get my price, so I didn't add. Arista's different because this would be a brand new position. After earnings, I put fair value at around $155, and for a new position, I want that valuation to make sense right from the start. The stock had already moved well past that, so I passed on Arista too. This is the key lesson for me this week. The sector can become more bullish, while the individual trade becomes less attractive. The confirmation got better, the prices got worse. And I'm not going to bend my rules just because the market moved without me. So I passed on both stocks, but I still wanted a way to play the semiconductor setup. On August 6th, I sold one SOXL $90 put that expires on September 18th. This is a cash-secured put. In simple terms, that means I'm agreeing to potentially buy 100 shares of SOXL at $90 per share if the option gets assigned to me, and I keep enough cash available to cover that purchase. In exchange for taking on that obligation, I get paid up front. That payment is called the premium. For this trade, I collected $9.60 per share, or about $960 total. Now, even though this is a cash-secured put, I'm not using it as a way to buy SOXL shares. For me, this is simply a trade. If it works, I'll take the profit. If the setup breaks, I'll close the trade and take the loss before I get to the point where I want to own the shares. The reason I took the trade starts with SOXX. I'm using SOXX to tell me whether semiconductor stocks are getting stronger. Once that signal confirmed, I wanted a way to trade that move. Instead of using SOXX, I chose SOXL because it moves more aggressively and its options were paying me more premium. SOXL is a leveraged ETF, which means it can move much faster than a normal ETF. That is why the premium is higher. But it also means the risk is higher if the trade moves against me. When I entered the trade, SOXL was trading around $122. I chose the $90 strike, which was roughly 26% below SOXL's price when I entered. Now, because I collected $9.60 in premium, the option's expiration break-even is $80.40. But that does not mean I plan to wait until SOXL reaches $80.40. That would be too late for my trading plan. My exit level is around $90. If SOXL falls below that area, I'll treat that as a sign that my trade is no longer working. My plan is to close the option and take the loss instead of waiting for assignment. Before I entered the trade, I also checked what the loss might look like around my $90 exit area. So let's switch over to Thinkorswim. This blue line shows the estimated profit or loss today, and the green line shows the profit or loss at expiration. If SOXL dropped to around $90 today, the model shows a loss of roughly $970. My maximum premium is about $960. So based on my planned exit, the trade is roughly 1-to-1 risk-reward ratio. Not bad for a 72% win rate. So before I entered, I knew 3 things: why I was taking the trade, where I would get out if I was wrong, and roughly how much I could lose around that exit point. That is the risk I'm willing to accept for this trade. Even after that trade, I'm not turning aggressively bullish across the board. The market's been strong, but this chart is another reason for me to stay disciplined over the next few months. On this chart, Trump's current term is sitting right around the same point where both his first term and Biden's term later ran into meaningful pullbacks. Those pullbacks happened under very different conditions, so I'm not saying 2026 has to repeat either one. The breakout could easily keep going. This isn't a crash prediction. For me, it's just a reminder not to chase stocks after a strong run. I'm cautious, not bearish. I'll still take a bullish trade when my setup lines up. I just don't want short-term strength to push me off my valuation discipline. I'd rather hold some cash and wait for prices I actually like in case volatility hands me a better opportunity later. Next week could be important. On Wednesday, we get the CPI inflation report, which could determine whether this market keeps pushing higher or volatility comes back. Then on Thursday, Applied Materials reports earnings, giving us another read on demand across semiconductors and AI infrastructure. And for my portfolio, will my SOXL trade keep making money? Or will Broadcom and Arista finally give me a price I'm willing to buy? You'll see exactly what happens and what I decide to do next week as the journey to $1 million continues. Every trade is posted to the Community tab before the outcome is known. Subscribe if you would like to follow the journey to $1 million in real time. I make the decisions. The market writes the ending.